Tokenization isn't a new concept. The advent of DeFi showed that you can actually attribute some utility to assets once you tokenize them beyond just issuing them and distributing them.
You've got the Wyoming stablecoin token. Avalanche was selected to be the chain of choice for the Frontier stable token. How did that come about?
They outlined the various metrics and parameters that they considered in the context of their selection process with those parameters in mind, plus, various presentations that we'd given to the commission. Avalanche, again, was chosen as kind of one of those networks on which to launch the token.
What's the sort of, I don't want to say next big trend in RWAs, but yeah, there's no better way to ask it. What is?
So I do think.
Hello and welcome to another video interview with CCN. I'm Eddie Mitchell. Today I'm speaking with Ava Labs' Morgan Krupetsky, VP of OnChain Finance. Hello and welcome to the show.
Thank you for having me. Appreciate it.
Matt, I really appreciate you joining me. We had a bit of a hard time scheduling this. I understand that you've been extremely busy. It's a good year for... Yeah, it is. It's a good year for RWA tokenization. I guess to get started, there's no better person to speak to about it. What's driving tokenization growth in 2025, and how is institutional adoption going to shape this over the next few years?
Sure. So tokenization isn't a new concept. These days, tokenized assets are referred to as RWAs, but even before kind of 2021, 2022, when tokenization kind of reemerged in focus, there were years before it where people in various shapes and forms were working on tokenizing assets back then. So in recent years, it's kind of reemerged as a trend. But I think on the one hand, this time is different, and I do think that the concept is definitely here to stay. I think this time around, we have a much more kind of institutional grade infrastructure in place between tokenization platforms, on and off ramps, the quintessential piece of infrastructure in RWA, which is stablecoins, and then really the advent of DeFi showed that you can actually attribute some utility to assets once you tokenize them beyond just issuing them and distributing them. You can potentially trade them and transfer them, eventually pledge them as collateral to kind of create greater asset mobility in that way. And so I think there's a lot more, again, infrastructure in place to really support the growth and adoption of tokenized assets. And then, 3 years ago, we had a kind of rising rate environment in the US and globally, which really put a spotlight on the need to bring real yield and real world assets on chain, which is kind of what spurred the growth of tokenized money market funds on chain today, which obviously that universe continues to keep growing. And then finally, you had a greater cohort of large asset managers that were not just touting the future as tokenization, but actually tokenizing assets in production on public permissionless networks, which was very exciting to see. And at the same time, we have and continue to have and see this growing market cap of stablecoins on chain today. At this point, I think we have about 250 billion in stablecoins across the various networks, across various stablecoins. And I think that's drawn a lot of the attention from asset managers thinking, can we potentially convert some of that capital into our money market fund products or private credit products or other products that might be interesting for the community of stablecoin holders who largely inherently don't earn a return on those holdings. And so that's kind of the thought process there. And obviously we've seen the space grow. We've seen money market fund, AUM on chain growing as well. Obviously it's not near the scope of stablecoins, but it does continue to grow. And then we've started to see the growth and proliferation of private credit funds as well. Prime example being Grove, which is kind of associated with the Sky ecosystem, allocated I think $1 billion into Janice Henderson's JAAA CLO product. And so I think that path will probably continue to grow and expand beyond just Grove into other stablecoin or synthetic dollar issuers as well. So I think in the grand scheme of things, we're still early.
It's very early, yeah.
But it's definitely, I think, picking up pace and drawing more and more into the realm of tokenization and institutional adoption.
Right, and this hasn't stopped people. The growth is, some people expect the growth to be in the trillions, sort of by the end of the decade. I've seen some reports saying it's going to be to tens of trillions by 2035. Some think it's going to be about 2 trillion in the next few years. And I suppose a lot of that comes off the back of this RWA tokenization, real yield, and a big offer for the institutions. But then you've got all this infrastructure in play, and obviously the US is arguably leading the charge. PayPal, probably one of the first big commercial stablecoins to launch and gain pretty decent traction. RLUSD is going more international, but it will have an amazing position after all the Genius Act and everything gets fully acted into law. But you've got the Wyoming stablecoin token. You were selected, Avalanche was selected to be the chain of choice for the Frontier stable token. This was over Cardano and Algorand, some other very high performance chains. So competition was pretty fierce, I would say. How did that come about?
So if you look, and all of this is kind of publicly out there, and I think a lot of the sessions throughout the decision-making process were recorded, and you can kind of see them online. But Avalanche was chosen as one of several blockchain networks. And the process, again, was pretty public and out there from inception all the way through to the end. If you look at the Wyoming Stable Token Commission's kind of process, they outline the various metrics and parameters that they considered in the context of their selection process. It was everything from underlying blockchain infrastructure and performance metrics, decentralization, security, kind of all those things that any issuer would probably consider when deploying on a given blockchain network. And so with those parameters in mind, plus various presentations that we'd given to the commission, Avalanche again was chosen as kind of one of those networks on which to launch the token. Shortly, we're hoping to see the token in kind of full production, with the first use case really being the ability to spend down and spend against the token really anywhere Visa's accepted, with the partnership through the Rain card, or the Avalanche card, leveraging the Rain issuance platform on Avalanche. And I think that part really closes the loop in terms of from initial minting to actually spending of the stablecoin, without necessarily having to go through the frictions of off-ramping it into fiat, but being able to, from a user experience perspective, spend it in real life, again, anywhere Visa's accepted. So I think that card component really helps to bring things to life for the holders of the token. That token could be, from an Avalanche standpoint, USDC, USDT, or any stable coin that a particular user prefers. So it's definitely exciting to kind of see that finally really coming to fruition.
Is it likely we'll see much more of these, or many, many more of these, I don't know, commercial specific from private companies, or, state-backed ones in the near future?
I think it remains to be seen in terms of which one or ones will take hold in terms of adoption. I do think that we'll see the issuance of many more stablecoins. Could be from more states or government entities, could be also from various types of private companies. So I think, there's a big question mark in terms of which one or ones will win out. And, the cases are infinite, obviously. And I think, to your point, especially after Genius, it really put a spotlight back on stablecoins for various companies, whether it's neobanks or fintechs, wealth tech platforms, even large banks, to consider launching their own stablecoins. I think in general, to the extent that you're an application and you on your platform own your customer or your users, it really makes the case to launch your own stablecoin and be able to offer net new product, services, and capabilities to your customers, leveraging whether that's stablecoins and other types of Web3 enabled products and services, fully abstracted away for your users. But importantly, what we're hearing in our discussions with various platforms who are considering leveraging their own stablecoin, it has to be that the stablecoin can move and live also beyond the walls of their application, to the extent that it can be interoperable with other networks or integrated with other applications and use cases outside of its kind of quote unquote walled garden.
Right.
That's really what a lot of these companies are also striving for, because ultimately, in order to really reach network effects for any one of these kind of given assets, you really need the idea of interoperability and composability. Otherwise, we're kind of recreating some of the foibles of Web 2.
Yeah, I mean, and even Web3, to be honest, how many times have like companies gone, okay, we're going to go all in on NFTs and we're going to have crypto rewards or an NFT based reward system for our people, our clients, our customers, and it falls flat because it can't do anything else but that.
Yep.
I think there's a risk of, do you think there's a risk of perhaps some cynicism arising when you just have, like a Starbucks coin, a Starbucks dollar come out or something like this?
No, I mean, I think a lot of it depends on how the company, whoever's driving forward the particular kind of use case, the success of it is determined by, frankly, the team within the company that is driving it forward. Is it a team that has senior management support, and prioritization, and do they see this technology, this tokenization, stablecoins, blockchain, programmability, tokenization? Do they see it as a tool to either improve their existing business model or as a way to enter net new markets, being geographically new markets or new types of customers, because the technology makes it operationally and economically feasible for them to do so? Or
Right.
are they looking at this as like a side of their desk type project, where there might not necessarily be senior leadership support? And are they hoping to kind of gain mass adoption by just selling to pure crypto natives? I think depending on the approach and how they think about the technology will ultimately help to dictate the success of the program or of the whatever it is that's being launched and driven forward by that particular company, because it gives you a sense and hint of how they see the tech, and is it like a solution in search of a problem, or is it a
True.
tool that helps to really drive forward particular business imperatives that they might have?
True. This is the big thing, is like, okay, the people, in order to go ahead and use something, there needs to be some sort of value proposition. Whether this is accessibility, potentially earning a yield, rewards, bonuses. Sometimes I struggle. I can kind of see if it's like a high level stable coin from a private company and they've got like a high idea for it and they have all this, everything's fleshed out properly. Are there still any sort of substantial risks even if like the business fails in another way?
Well, I think as a general observation, and this kind of goes back to my point previously, is as any company, whether you're a startup or a very established company launching something on chain, that could be a stable coin, another type of tokenized asset and application, you can't necessarily expect you to kind of go through all the effort to launch the thing and then expect people are going to rush to use it and adopt it. There needs to be a very large kind of customer acquisition effort and business development effort. There needs to be work done in terms of enabling the correct integrations with, let's say, exchanges or wallets or whatever that might be. There's a lot of business development work that needs to be done in order to effectuate the adoption, the use cases, and the integrations in order to really kind of see the success of the thing. In the same way, just because you tokenize an asset doesn't necessarily make an unattractive asset historically or off-chain attractive on-chain. So a lot of people kind of look at, erroneously, the tech as like a panacea to solve a lot of these issues. But, a crappy asset is a crappy asset. So the tech is really more so and should be considered as like an enabler to be able to drive certain things forward, but it's not necessarily the solution that solves, certain non-technical problems. It really is
Right.
a way to kind of manage certain things or enable certain things. But you have to have, other kind of efforts in business development to really drive forward that adoption.
So obviously it's going to take a fair amount of innovation to drive forward the adoption, because again, you don't want to create a token in search of a problem. You want to bring new things that people haven't even potentially thought of. From where you're at right now, what's I guess beyond the Visa cards and low friction stable coins, what's the sort of, I don't want to say next big trend in RWAs, but yeah, there's no better way to ask it. What is
What's
sort
the
of
next
coming up?
trend? I don't think stable coins are going away anytime soon. Unfortunately,
Yeah,
people have said stable coins are the killer app for crypto. And it really is, I think, just like DeFi, the top of the funnel for a lot of, different use cases and things to kind of be built on top of, right? Like the proliferation of stable coins led to the proliferation of money market funds, which
absolutely.
is also leading to the interest in private credit and so on and so forth. So I do think the attention on stablecoins isn't going to go away. I think it's going to grow, but because it's going to grow, I think that there's going to be a lot of net new and very interesting opportunities that arise and pop up as a result of the proliferation of stablecoins. One example being the rise of what we call the payment finance landscape, which is really the growth in opportunities in on-chain credit. And so what I mean by that is there's a lot of companies, as the growth of stablecoins, proliferates in the US and globally, various companies, whether they're on and off ramp providers or stablecoin orchestrators or remittance companies, will need to draw on credit facilities or private credit offerings or even credit from banks or other types of funds in order to be able to facilitate the atomic or sufficient liquidity and atomic sending and settlement of cash. And so with this growth in stablecoins, I think that private credit opportunity will also, in a correlated way, continue to grow as well. And so at this point, we're seeing, different players trying to cultivate liquidity for those types of opportunities. Clearpool has actually recently launched a PayFi type product. Various more crypto native funds are coming in to fill that gap. And eventually, I think more traditional funds will come in and be able to analyze and provide credit for those types of opportunities. So I think that's something that will continue to grow, the payment finance piece.
Right.
And I think that also leads into some of the work that we're doing in the private credit space, where we're using stable coins and programmatic credit facilities to make how private credit off-chain today operates, make it better, make it more efficient, make it faster, and ultimately offer various originators who are in turn making loans to individuals or businesses, offer them better money, and better because it's programmable and because it's able to move much more quickly, and therefore more attractive than potentially facilities leveraging traditional rails.
Right. And how does this, in what way do you think, or would you be able to explain that this could like trickle down to the retail markets?
So I think there's a lot of ways, and then I'm sure there's a lot of ways that like we haven't even thought of.
Right.
I think first and foremost, especially in the global South, where stablecoins really, especially dollar-denominated stablecoins, have really taken a hold. More companies offering dollar exposure through dollar-based stablecoins in the back and then by extension, digital savings accounts, and then by extension, stablecoin enabled card products. I think obviously we've seen that, but I think that will kind of continue to grow. I think from the private credit side of things, which we also talked about, eventually what I think could happen is there's sufficient efficiencies created in the process such that eventually you might be able to engineer a lower cost of capital for various types of institutions and originators, which potentially could trickle into lower rates for consumer loans or mortgages or small and medium-sized businesses, which, you could see how that would have a direct impact in terms of, the proliferation to retail and other types of small businesses and retailers.
I think the property one is something that's come up quite a bit, and that I think that would probably be one of the more profound impacts if costs can be lowered and access to capital can be made easier, and the housing issue would be phenomenal. It would be phenomenal.
Yeah, I mean, I think some of we take mortgages as an example. I mean, some of the rate is reflective of just like a lot of middlemen helping facilitate and operate the process. And because of blockchain rails and the ability to have the various parties related to that process leveraging a common data standard and platform, it kind of takes away the need for some of those third-party intermediaries, in some cases whose job it is to take one Excel sheet from one party to another. Well, why do you need that? You could just leverage a blockchain in that case. So I think by removing some of the costs associated with a manual process, you can remove some of the third-party intermediaries that help to facilitate that, and therefore eventually kind of lower costs for the end borrower, the end consumer.
So I guess my last question would be then is, we like at the start of 2017 when the ICOs were booming, that message of blockchain can streamline, simplify, cut costs, more efficiency, we're going to cut the middleman, and now we're talking about it finally sort of coming together and actually happening 7 years later. How far away are we from the big mainstream adoption wave?
That's a good question. I mean, I think I think a lot of us who are in this industry feel like everything's moving so slowly, and especially those like OGs who've been working on this for like 10 plus years. I'm sure they would have thought that we'd be a lot further along by now. But frankly, if you look at where we're at today as an industry versus where we were at a year ago, it is a 180, right? I mean, so many macro and regulatory tailwinds that have helped to really turbocharge, a lot of the developments that we've seen in the past year. And I think that will hopefully continue. Again, I think we're early in the grand scheme of things, but I think where we're at now is definitely at a place where institutions feel like this technology is too hard to ignore. And I think they are beyond, hopefully many of them are beyond the point of saying, oh, this whole space is a scam. They've delineated between crypto and meme coins and blockchains and stable coins, and to that end can kind of see the benefits of the underlying technology. Like, I think we're past the point where I have to sit there and explain why a blockchain is interesting and why an institution should consider it, which is a good sign.
Yeah, absolutely. The FOMO is real now.
Yeah, there's definitely a sense of FOMO, especially as fintechs and neobanks have the ability to move a little bit more quickly and are a little bit more tech enabled. And I think a lot of the incumbent banks are watching that space to see, who's doing what, who's issuing what, and what does that mean for their business, which is a good sign, because I think, again, it instills a sense of urgency and FOMO, and a little bit of FOMO I don't think is a terrible thing.
No, it's competition.
Yeah, exactly. So I think we're at the beginning, I would say, I hope, of a period of acceleration in terms of broader adoption.
I think we're pretty much, yeah, you're pretty much there. I think 2026 will be a really big year.
Yeah.
Well, as promised, I won't take up too much of your time. I'm sure you are super, super busy.
No.
Morgan, thank you so much for your time. Is there anything we should be looking for from Ava Labs in the coming weeks or months?
No, just that. I mean, our mission from the beginning has always been to digitize and tokenize the world's assets. So we continue to add large asset managers, banks, and tokenized assets to our ecosystem. In fact, overnight we added a huge Korean asset manager, Murray Asset, to our institutional ecosystem, working on various tokenization initiatives with them. So I would just say, as you watch the Avalanche ecosystem, I think that space and the broader enterprise adoption space on Avalanche will continue to grow.
Awesome. Well, then we'll keep our eyes there. Thank you again so much for your time.
Thank you for having me.